My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, I'm just trying to save you a little money. My job is not just to entertain you, but to educate, teach you, and put tough days like today in context, so call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Sometimes we have no idea what some big, bad event means to the market. So what do? We figure we might as well sell. That's how I feel about Wall Street's reaction when Fitch, the ratings agency, took our country's debt down a notch last night thanks to our dysfunctional federal government. They know nothing! Fitch previously rated our debt AAA, and now it says we're AA+. The decision came out of the blue and helped bring us a torrent of selling, Dow tumbling 348 points, S&P plunging 1.38%, and the NASDAQ plummeting 2.17%. Did the wholesale dumping of stocks make sense, though? Actually, yes, if you're a portfolio manager who abandons stocks when interest rates go up, which is what happened pretty viciously in the wake of the debt downgrade. Treasuries seemingly can't be worth as much as they were before Fitch decided to hammer them. So the thing goes, stocks therefore can't be worth as much either, as hundreds of billions of dollars change hands based on the direction of bond yields. When those yields go up, rates go higher, people automatically sell stocks. It didn't help that Fitch added we could see a recession if the economy slows. No kidding. Very hard to see a recession if the economy doesn't slow. Now, in this business, it's axiomatic that the stocks that get hurt the worst when rates go up are the high flyers, the stocks that trade based on the prospects far out in the future, the techs. So they experience a huge amount of pain. Now, I want you to take Cramer favorite advanced micro devices. Last night, AMD reported a truly fine quarter with tremendous growth in semiconductors for artificial intelligence. The stock immediately shot up 6 points in after-hours trading. You knew it was going to be a terrific day the next day for AMD based on these terrific fundamentals. Then out of nowhere, we got the Fitch downgrade. Yeah. After U.S. Treasuries slipped to their AA+ rating, AMD stock went from being up $6 to being down $8. Having interviewed the CEO, Lisa Su, this morning on Squawk on the Street, I can tell you nothing else happened here beyond the sovereign debt downgrade. Consider it the control, like in a lab experiment. 14-point swings based on the bonds, not the stock. Not the fundamentals of the company. Does any of this make sense? Look, you could easily argue that our government is dysfunctional because every time it's time to raise the debt ceiling, the two parties go at it hammer and tongs with a real danger that the bills won't get paid. It's definitely not good that these standoffs happen regularly. We're a quirk of our system where the government can run out of money even when it's totally creditworthy. Other countries don't do this. When they default, it's because everything's falling apart, not because the main political parties hate each other. But you know what? That's certainly not a new concern. And you know what? It did impact AMD, and it hurt AMD, and I wish it hadn't, because if AMD reported another day, it probably wouldn't have. So let's boil all this down. Let's figure out historically what it means to have our debt downgraded. Sure enough, you know what? We're very lucky. We're blessed. We have an analog. 12 years ago, we had a vicious battle over the debt ceiling that also hurt the economy. What happened? S&P, the other big ratings agency, downgraded U.S. debt in what seemed like almost a cataclysm at the time. The stock market, which had been plummeting before the downgrade, really got smacked down as the nation was plunged into fear and a bit of loathing. And you can see this. If you don't mind, I'm going to walk over here and show you exactly kind of where we were. The S&P 500, which had been trading as high as 1356 in July of 2011, this is 2011, okay, had fallen to just under 1,200 on recession fears stoked by the debt ceiling standoff. When we got the surprise ratings cut, the S&P fell even further, as low as 1,101 within a couple of days. This is a real plummet. Altogether, this ended up being about a 19% decline. And it was totally temporary. That's right, this whole thing, all the debt stuff, you could just wipe it away because it was totally temporary. It was an awesome buying opportunity because 1 year later, the S&P 500 was back up at 1,402, like the whole thing never happened. The sovereign debt downgrade was an incredible buying opportunity. Buy. I know it often sounds simplistic. You know, it sounds like, oh, yeah, buy opportunity, but that's what it was. See, I remember it well. I've been at the Philadelphia Eagles training camp. I've been a season ticket holder forever, and I like to think of myself as a friend of the team. I often get to address the players and talk about finance. Most of the time, they're not really interested. I mean, who can blame them? When you're out on a hot field for hours on end, you're not going to want to hear from someone who suggests, well, you know what, you ought to put your 401k in an index fund, or that you have to protect that nest egg with municipal bonds because you only need to get rich once. But when I went during the debt ceiling crisis, I was the most sought-after speaker on the sidelines. One after another, players asked me what it meant for their paycheck, for their savings. Many wanted to know if they could still invest in the United States, or would this mean that our country might ultimately default on its obligations? I worked hard to try to dissuade people from selling their stocks, going as far as to say maybe they should even think about buying them, but it was all for deaf ears. It was actually pretty awkward, because while I was viewed as someone who knew something, the players didn't know what I was doing there, and they were just plain fearful, like pretty much everyone else at the time. Believe me, it's a little unnerving when you see a 350-pound pro football player agitated by the S&P's credit rating division. I finally took the bull by the horns that day and said, people, listen, I'll tell you what I'm going to do. I'm going to put money in my 401k as soon as possible. I know it's a pilot, but I think it worked because next year, needless to say, I was the belle of the practice ball. Now, this time, unlike 2011, we came in hot to the sovereign debt downgrade. Not only is tech been on fire, but we also have hapless meme activity with low-dollar stocks like that of a liquidating trucking company that just went bankrupt, or a kitchen canister maker with going concern issues. Both are trading way too hot. I think that means the situation in 2011 is exactly the same. On the other hand, the second ratings agency downgrade is never going to hit as hard as the first one. So just as we can rely on historical examples to draw a conclusion based on 2011, I want to offer another thesis, courtesy of the Bank of America Equities Trading Desk. As of the end of July, Monday night, the S&P 500 was up just under 20% for the year. Do you know that if you go back to 1928, when the S&P 500 is up at least 10% through the end of July, as it is now, there are only 3 years where the market was lower over the course of the next 5 months. And all three are pretty easy to understand: the 87 crash, the 29 crash, and 1943, when we were still uncertain how World War II would play out. Now, those are some very powerful, I think, dispositive, as we would say at law school, statistics. Will people react in fear to the Fitch downgrade beyond today? I think we won't really get all that much follow through. My gut tells me big money managers used it as an excuse to do some trimming today. Makes sense. As I said last night, I do see some froth in the market, not as much as I expected, but enough to make me concerned. All you have to do is look at which stocks had the biggest short positions, buy it, and ride the resulting short squeeze higher. When we get that kind of stupid behavior, you got to curb your bullishness and husband some cash. I think that's where we found ourselves today. We need to see more fear. I'm not going to say that I want to go back to the Eagles practice field and poll them on how they're positioning their millions. I am saying that the action today was so severe and the sell-offs in tech so vicious that it's worth waiting to see if we can't get some sort of bottom that's based purely on fear and loathing out in the future. We're looking to put some cash to work for the Travel Trust. We sure got a boatload of it, but we still think we might get better prices, and that means lower prices. We think they await us. Join the CNBC Investing Club to learn more. Bottom line, I'm not concerned about the Fitch downgrade. I am concerned that too many people remain too sanguine at the moment, because that's not what we want to see. When you get too many bulls, it tends to eventually cause a nasty sell-off. So maybe some fear and some loathing are just what's called for. Let's go to Jeffrey in New York. Jeffrey.
Mr. Cramer, I'm a club member and first-time caller.
Thank you, Jeffrey, for calling, and thank you for being a club member. We're putting out some great stuff. People should really get involved. How can I help?
Well, I'm a long-time follower of your advice from when I was appreciating guidance from Reverend Jim.
Oh, geez, the old days with Mark Haynes. How much I loved coming home with him. How can I help you?
I bought ULTA Ulta 6 weeks ago at 185 and declined. Has accelerated the last several weeks to below 140. Is ELF and Oddity taking market share and the reason for the decline? Ulta earnings are August 23. Right. What is your advice and guidance now?
Okay, so ELF did have a great quarter. It's absolutely terrific news. There is a correlative to Ulta. Ulta at 438 is kind of in no man's land, sells at 17 times earnings. We love Dave Kimball, who is the CEO, and I think Ulta is a very good buy, but it is a very tough trader. Let's go to Gordy in Washington. Gordy.
Booyah, Cramer. Thanks for taking my call and all you do.
My pleasure. Booyah. What's up?
Hey, it took a while and a lot of hard work, but I finally got to 1,000 shares of Ford. And I'm thinking if I would have done something else, maybe could have made some scratch. But it is what it is. Hang on or sell some.
I want you to hang on. I'm not happy. I do fear a strike. I also fear that the electric vehicle division is losing too much money. The rest of the company is making a lot of money. They actually did guide numbers up, but they have to figure out a way to be able to make it so the electric vehicles don't drain all their profits, and we'll have to see if that occurs, but it has been disappointing. Let's go to Mitch in Arizona, please. Mitch.
Yeah, Jim, Mitch in Arizona, that's correct. Question.
Excellent. Yeah.
Would you agree that earnings report in most cases are stock killers?
Are stock killers? No, I think that it depends on where stock is coming into an earnings report. I think there are a lot of companies that people don't believe in, and when they report, they're surprised to the upside. I'm going to give an example, one from the trust. I mean, take Procter & Gamble. Everyone thought Procter was going to miss, okay? Procter did a very good job. The stock has just been straight up. That's an example of what I like to see. There are plenty of buzzkills, like a Qualcomm tonight, which is exactly what you said, but I'll trump that with a Procter. Let's go to John in Texas. John.
Hey, Jim, I've been watching you since the Kudlow days.
Jeez, people have been hanging with me for a long time. What's up?
You guys taught me that earnings are the mother's milk of stocks.
They sure are.
Hey, Jim, I wanted to ask you about one of my long positions in the aerospace and defense market.
Okay.
Significant aftermarket position. Jim, what are your thoughts on TransDigm?
TransDigm is a very, very good company, and the aerospace business is very good to them. And I know that they have got a good balance sheet and can do a lot of different things. It has been in one of my bull market sectors, and I'm going to tell you, I think it's good. All right, look, I am not concerned for our nation because of the Fitch downgrade. I am concerned that there may be too many people right now who are too sanguine about the stock market because we don't want to get too close to a very nasty sell-off in light of what we've been seeing, which is some froth and a belief that stocks don't go down anymore. Oh, man, everybody, tonight, Columbia Sportswear fell 4% today after earnings. So what's it going to take to have the company dressed for success? I'm going to check in with the CEO. Then it's day 3 of chart week, and we're bringing in the legendary Larry Williams, the man himself, whose big call on Tesla, well, let's just say you got to see it. And DoorDash popped after turning in a strongly expected quarter in a very tough tech tape. I'm taking a bite of the numbers with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.